Do you want to sell when the market is soaring or buy when it's crashing? The answer is simple. Execute rebalancing. Once a year or when your allocation shifts significantly, execute it mechanically. Why does it work? This slide explains everything. Rebalancing is adjusting back to your target allocation. Execute it periodically or when thresholds are reached. For example, your 60% stocks, 40% bonds allocation shifts to 70% stocks, 30% bonds due to market movements. At this point, you sell stocks and buy bonds to restore the 60-40 split. This is rebalancing. You sell the asset that rose. You buy the asset that fell. Pure contrarian strategy. What do emotions do? Buy high, sell low. Follow the herd. Rebalancing forces the opposite. Sell high, buy low. This is a disciplined risk management approach, widely supported by decades of research and practice. It's not price prediction. It's rule-based trading to restore your target risk. And this is achievable. Once a year, schedule it on your calendar. Or adjust when allocation drifts more than 5% from target. This puts you on the opposite side of the crowd. Today I'll show you how it works. Now let's look at the automatic buy-sell mechanism of rebalancing. Stocks rise. Your allocation increases from your target 60% to 70%. What does rebalancing do? Sell stocks. Automatically. Bonds fall. Your allocation drops from your target 40% to 30%. What does rebalancing do? Buy bonds. Automatically. Pay attention to this. You're not predicting the market. You're not reading the news. You're not listening to expert opinions. You're simply looking at objective numbers, your allocation percentages. It drifted from 60% to 70%. So you adjust. That's it. This completely eliminates emotion. No fear, no greed, no hope, no anxiety. All irrelevant. Behavioral finance research shows that excessive trading tends to erode average returns. Mechanical rules prevent that. That's the essence of rebalancing. So how often should you rebalance? Vanguard's research provides the answer. Once a year, or when allocation deviates 5% from target. Either approach or a combination is rational. Why? What happens with monthly rebalancing? In taxable accounts, tax burden increases. Spread costs and management overhead multiply. These erode your returns. Quarterly rebalancing, tax and administrative burden increase. Frequent trading worsens tax efficiency. Every 2 years, you let allocation drift too far. Risk deviates significantly from your target. Once a year, or 5% threshold, this balances everything. Minimize costs while maintaining allocation. When should you do it? End of December is standard. Easy to combine with tax planning. Or your birthday, fiscal year end. Choose a memorable date. What matters is executing on the same date every year, or at a clear threshold. So what's the actual impact of rebalancing? Here's a critical truth. The primary purpose of rebalancing is risk management. It doesn't guarantee higher absolute returns. In fact, not rebalancing and letting it ride can sometimes produce higher average returns. Why? Because your stock allocation keeps rising. But here's the trap. Risk exceeds your tolerance limit by a wide margin. For example, your target was 60% stocks. But without rebalancing, stock gains push it to 80%, 90%. What happens when the market crashes in this state? The losses are devastating. What does rebalancing do? It maintains your target risk level. It automatically constrains stock allocation growth. That's why it maximizes risk-adjusted returns. The impact varies with market conditions, correlations, volatility, and costs. But long-term, it grows assets while managing risk. That's the essence of rebalancing. Rebalancing also reduces risk. What happens when your stock allocation rises? Losses in a crash expand. For example, your target was 60% stocks. But without rebalancing, Stock gains push it to 80%. What happens when the market crashes in this state? Losses increase dramatically. What does rebalancing do? It automatically constrains stock allocation growth. When it exceeds 60%, you sell. That's why it can reduce losses in a crash. In past market crashes, rebalanced portfolios tend to experience smaller losses because stock allocation is constrained. But let me be honest, rebalancing isn't perfect. In inflationary periods like 2022, stocks and bonds fell simultaneously. It was a brutal year for traditional 60/40ths portfolios. Bonds aren't always a safe haven. Still, rebalancing is the best tool for maintaining long-term discipline. No emotional drift, target risk maintained. That protects your wealth. Now let's look at 2 techniques to optimize rebalancing. First, threshold-based rebalancing. Say your target is 60% stocks, but you don't need to restore exactly 60% every time. Set a 5% threshold. If you're within 55% to 65%, do nothing. Only rebalance when you move outside that range. What's critical here is using absolute values for the trigger. With a 60% target, rebalance at 55% or below or 65% or above. Why? Frequent trading on small drifts increases costs. Thresholds eliminate unnecessary trades. Second, tax-efficient execution. Where you rebalance matters. IDCO, NISA. In the U.S., 401k, IRA. Rebalance inside these tax-advantaged accounts. No taxes on trades. Minimize rebalancing in taxable accounts because capital gains taxes apply. What if you sell assets at a loss? You can use tax loss harvesting and carry forward deductions. Further reduce tax burden. These techniques enhance the effectiveness of rebalancing. But what's the greatest value of rebalancing? It's not risk management. It's eliminating emotion. What do humans instinctively do? Buy high, sell low. 2000, the dot-com crash. When the market hit bottom, what did investors do? They sold. Dominated by fear. 2007, the peak of the housing bubble. When the market hit all-time highs, what did investors do? They bought more. Dominated by greed. Emotions dominate judgment and generate losses. What does rebalancing do? It forces the opposite of emotion. You sell the asset that rose. Ignore the greed saying it might go higher. You buy the asset that fell. Ignore the fear saying it might go lower. Mechanical rules. An emotion-free system. And this is the only way to succeed long-term. If manual calculations feel tedious, using balanced mutual funds or robo-advisors that rebalance automatically is a smart choice. What matters is having a system. Now let's summarize today's key points. Here's today's summary. First, rebalancing manages risk. By maintaining your target allocation, it reduces losses in crashes. It automatically constrains excessive stock allocation growth. It functions as insurance. While it doesn't guarantee higher absolute returns, it maximizes risk-adjusted outcomes. Second, execution method matters. Once a year, or when allocation deviates 5% in absolute terms from target. Either approach or a combination is rational. Executing inside tax-advantaged accounts like IDCO, NISA, 401k, IRA minimizes tax burden. Third, rebalancing eliminates emotion. Humans buy high and sell low. Rebalancing forces the opposite. Mechanical rules. Fear and greed are irrelevant. You're freed from being a slave to market psychology. Have you executed rebalancing this year? Do you have an annual schedule or a clear threshold rule? Share your rebalancing strategy in the comments. Your allocation percentages, your execution frequency, your success stories. All of it becomes wisdom for this community. Thanks for investing your time with me today. This channel breaks down rebalancing, asset allocation, and concrete strategies for financial freedom with numbers. We provide methods to build wealth through systems, not emotions. Subscribe to the channel and gain deeper insights in the next video. See you in the next one.